Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday the 3rd of June 2020. And yesterday we commented on why silver and gold fell back and why equities rose, albeit only modestly. The video was entitled, Silver Falls Back as Equities Rise. Is this just consolidation? And we basically proffered our analysis that we can expect silver for the time being to vacillate between $17.50 and $18.50 for a short while, with $17 acting as a very strong but not impregnable support level, and $19 acting as a very, very strong resistance level, with $18.50 being quite a resistive level in itself. Now we say this against the backdrop of virtually every other channel coming out saying prices are going to the moon, and soon, and yet again quite sickening in our opinion, and quite deceiving, to say the least. Keith Newmeyer spreading his garbage that silver is going to $100 an ounce very soon. Sorry if you're a fan of his, but frankly $100 silver in this environment is garbage. Unless the whole economic system completely breaks down, and then your loaf of bread will be $10, so $100 silver will mean very little in reality. Don't forget, Newmeyer has made this same prediction for a number of years. Check it out on YouTube. Don't have to believe us. Just bear this in mind though. With his ownership of silver mines, every dollar that the silver price goes up, his business makes an extra couple of $1 million. We shall say no more on the subject. So, it's Wednesday morning, 11 a.m. GMT +1. And we look at the markets. US stocks closed up on average 1% yesterday, and UK and European stocks are currently up between 1.5% and 2.5%, while Asian stocks, which are now closed up around 1% in general. Gold has continued its dip though, and currently stands at $1,719. And silver has, for the moment at least, broken below the $18 support level and stands at $17.91. Now we did say in yesterday's video, quote, for the moment equities are discounting any bad or negative news and are focusing on the lockdowns easing and some economic data not being as bad as anticipated. For how long they can continue to do this remains to be seen. However, if the economic data continues to improve, as the high levels of stimulus works its way through the marketplace, then this will act as a headwind for precious metal prices, though silver will be less adversely affected because of its industrial demand component, unquote. Now, some interesting articles have been published this morning. The first is by Reuters, talking about Eurozone producer prices and why they are important. Let's take a look. Reuters article dated 3rd of June 2020. Headline, Eurozone producer prices fall more than expected. Unemployment edges up. Eurozone producer prices fell more than expected in April as the economy slowed to a crawl in the second month of containment, measures against the coronavirus pandemic, but unemployment rose only slightly, defying more pessimistic forecast data showed. The European Union Statistics Office, Eurostat, said prices at factory gates in the 19 euro countries fell 2% month-on-month in April for a 4.5% year-on-year decline. Economists polled by Reuters had expected a 1.8% monthly and a 4% annual fall. The decrease was mainly a result of a plunge in energy prices, which tumbled 7.5% month-on-month for a 16.5% year-on-year fall. Without this highly volatile component, producer prices eased only 0.3%, both on a monthly and a yearly basis. Producer prices are a key factor shaping consumer inflation, which the European Central Bank wants to keep below but close to 2% over the medium term, as changes in prices at factory gates largely translate into the final cost for consumers. Also important for inflation, and therefore ECB monetary policy, is the unemployment rate, which shows trends in consumer demand and therefore rising or falling inflationary pressures. Eurostat said the number of people that lost their jobs in the Eurozone in April was 211,000, bringing the number of unemployed to 11.919 million, or 7.3% of the workforce, up from 7.1% in March. Economists polled by Reuters had expected a jump to 8.2%, but their forecast was based on previous Eurostat data for March, which the Statistics Office now revised to 7.1% from the previously reported 7.4%. To some extent, this suggests that the euro situation may not be as terrible as some have predicted, and particularly inflation is not seen as a concern. Well, upward inflation, that is not seen as a concern. Perhaps deflation is. The second article is by Bloomberg, which suggests that the European Central Bank will have to increase its stimulus provisions tomorrow. Otherwise, this could have quite severe consequences on markets, which so far are heading in positive territory. So let's take a look at what Bloomberg had to say this morning. Bloomberg, dated 3rd of June 2020. Headline: ECB seen with only one choice tomorrow: to avoid market rout. European Central Bank policymakers face the peculiar situation this week of being widely expected to announce more monetary stimulus well before they run out of the ammunition still to hand. The European Central Bank has so far spent less than a third of the €750 billion, or $840 billion pandemic emergency purchase program that it started in March. At the current pace, it could wait until its July or September meeting before judging whether the program is big enough to soak up the debt issued by governments to fight the recession. Similarly, the market stress that pushed the ECB into action has faded, partly because of the central bank's bond buying and partly because the European Union has moved closer to a common fiscal response through a €750 billion recovery fund. An Italian bond sale Wednesday attracted record demand. Yet anything less than a widely anticipated increase to the bond programme could trigger a market shock reminiscent of the one in March, when President Christine Lagarde inadvertently suggested that she might not act to calm peripheral bond markets. No increase in the pandemic emergency purchase program is basically a big jerk for the periphery, said Pooja Kumar, senior European rate strategist at Toronto Dominion Bank. An overwhelming majority in a Bloomberg survey conducted last week expect the Governing Council to top up the asset purchase program by €500 billion. The prospect that some central bankers might prefer to delay was raised in an article this week by Newswire Market News International, which competes with Bloomberg News, saying many members of the Governing Council would oppose an increase. Krishna Guha, head of central bank strategy at Evercore ISI, said the article, based on unidentified sources, was disturbing and couldn't be dismissed because it would not be the first time that the ECB and Europe in general has stolen defeat from the jaws of victory. Holger Schmeiding, chief economist at Berenberg, reckons an increase in pandemic purchases will be announced, but put only a 60% probability on that happening. The ECB itself has built expectations for action. Policymakers have repeatedly said they're ready to boost the program if needed. Executive board member Isabelle Schnabel said the decision would be tied to the economic data. And Bank of France Governor François Villeroy de Gallau said, we will very probably need to go even further. The data suggests that while the worst may be over, the recovery will be painfully slow. A gauge of economic activity published Wednesday rose to the highest in 3 months for May, yet it merely showed the contraction slowing, not halting. German unemployment climbed to a 4-year high. Lagarde has already said the euro area recession this year will likely be somewhere between the central bank's medium and worst case scenarios, signalling a contraction of around 10%. That'll be backed up by new projections in her press conference on Thursday. Moreover, the EU's recovery fund heralded as an historic breakthrough, still has to be agreed by all 27 member states and could yet be watered down. Even when it does come into effect, the funds won't start being issued until next year. It would be rather stupid of them when they have forecasts and see where the downside risks are to suddenly decide to delay, said Marshall Alexandrovich, an economist at Jefferies. That would really be an own goal after spending so much time and money on trying to support the economy and markets. Policymakers will be reminded that Europe is far from being back to normal by the fact that the meeting and Lagarde's press conference will be virtual. Countries are easing their lockdowns while keeping many restrictions in place and repeatedly warning of a resurgence in the coronavirus if people don't heed them. There is obviously a case to be made for them to wait, said Piet Christiansen, an economist at Danske Bank. You could argue, let's wait to see how economies open up before we commit to more. But it's no time for heroes and waiting this out. There are major risks, and I don't think the European Central Bank can actually afford to delay. Now, what this suggests to us is that once again, central banks are using their might, their economic might, vis-à-vis money printing, balance sheets, QE programs, etc., in an attempt to ensure that governments are able to raise monies to fund their stimulus programs to stave off the main effects of a global recession. Now, those who follow Austrian economics or traditional monetarism will be quick to point out that this cannot go on forever without serious hyperinflationary consequences. They are right. However, where they have been wrong so far is in the timing. What many of these followers of Austrian economics seem to miss is the fact that when you have the world's central banks and governments more or less working in concert with each other, or at the very least following similar policies, Judgment Day can be delayed many years into the future. Admittedly, though, leaving other generations to clear up the mess. And this is what we are experiencing at present. What do you think? Do share your thoughts. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.